Let's move right along now. And financial group WT Financial is set to acquire Synchronized Business Services in a deal worth almost $8 million. Now, the acquisition will see WT emerge as the largest advisor network in Australia. To tell us more about the deal, we're joined by Chief Executive Keith Cullen. Keith, welcome to the program.
Yeah, thanks very much indeed. I appreciate the opportunity.
Before we get into the acquisition that's been announced today, I wanted to get a bit of background into the company. It sounds like a really interesting space. Tell us the story.
Yeah, it is. Look, I mean, we think financial advice in Australia's got an enormous future ahead of it, despite the tailwinds that we've seen, or the headwinds we've seen rather, in the wake of the Royal Commission, with a lot of the banks exiting the space. Australia is about to undergo the greatest intergenerational wealth transfer in history, with about $3.5 trillion moving from one generation to the next, and people need advice. So our business is all about supporting a network of independently owned financial advice practices around the country. We've built that to about 250 over the last couple of years through acquisition and organic growth, and now we're set to emerge as Australia's largest non-institutionally owned advice network. So we'll still have IOOF and AMP ahead of us, but we're a non-product producer, we're not a distribution network, we're an advice network. That's a differentiator right there.
Keith, so tell us about Synchron. That's the latest acquisition that's been made. What's the attractiveness of that particular company?
Well, look, it brings incredible scale, but it's also got a terrific brand in the industry. As Don Trapnell and John Prosser, the founders of the business, founded it over 25 years ago now, and they've built it into Australia's largest privately owned network, and they've got a great reputation across the industry. And so we get to inherit a lot of that intellectual property from them, and both Don and John will be staying on. And of course, then it brings scale to enable us to really broaden our services that we're providing to advisors.
You said that it's going to be highly accretive in the press release that went out to the ASX. Is that going to be immediate, or is it going to take time to go and find those synergies with the company?
Yeah, no, we're confident it's immediate. We've given upgraded guidance for the FY 2023. We haven't upgraded our guidance for 22 yet, because we'll just see where we land settlement-wise. But we'll see next year. We're very confident we'll go to about 170 million in gross revenue, and we should be able to deliver an EBIT comfortably above $5 million and a net profit after tax above $4 million, which is about a doubling from where we are today. So very accretive acquisition for us.
You've been busy, as you mentioned. I know lots of acquisitions. Century was another one of those. How's that been going when it comes to integration to the business?
Yeah, it's been terrific. Look, I mean, the challenge with Century has been that a lot of the advisors are over in Perth, and the business was head officed over there. So, you know, we've had all of those travel restrictions in place that have made it difficult, but the advisors have responded well. The team has really stepped up to the plate, and we've got those great integration benefits there. We had guidance again for 2 million plus net profit for the year. We've just published our half year results a couple of weeks ago with 1.65 of EBIT and 1.12 of net profit after tax. So it's working. We're delighted with it.
Keith, we've got you in the studio, so I have to go and ask you about the regulatory burden on advisors in this country. Has the pendulum swung far towards being punitive? Because that's one thing that comes across constantly on the program, is that it's detracting from the actual product and the core need to go and give advice, because things have become so punitive in the way they're being structured.
Yeah, look, punitive mightn't be the right word, but it's certainly burdensome. There's when you look at Chapter 7 of the Corps Act, which is what regulates everything that we do in the industry and advisors do day to day, I call it, I heard an expression years ago that said a camel is a racehorse designed by a committee. And that's what Chapter 7 feels a little bit like. The problem with that section of the Corps Act, it was written in a day to deal with product sales, the distribution of product by sales forces. And now we've got a professionalised industry that's all about providing professional services on a fee-for-service basis. And what we've had is we've had different bits and pieces added on across the last sort of 15 years, and particularly in the last 10 years. We've ended up with this cumbersome thing where there's a lot of duplication in the regulations, and that adds cost to being a dealer group, which adds cost to advisors, which adds cost to mums and dads that are seeking advice, or anyone that's seeking advice. So it needs to change, and I think we're seeing the attitude of regulators, Treasury, ASIC, and those in government recognise that, and it's time to rewrite that whole section of the Act.
What's the trajectory for longer term when it comes to margins and the like? Because we do have less advisors out there. You talk about the cost burden that's placed on the business. Where does that trajectory go longer term?
Yeah, look, I think from a dealer group perspective, which is what we are, it's important to have scale, because if you want to serve your advisors well, you've got to have, you know, the right level of intellectual property in the business that understands a whole bunch of different sort of factors of dealing with clients and building a practice. That IP is expensive, but it's also really able to be scaled. So if you can underwrite it with a big enough group, you can provide the right services. For individual advisors, I think, you know, they've really been pushed further up the scale from sort of middle Australia to middle upper Australia, and it's going to keep going in terms of the costs that they need to charge to maintain their margins, unless we see something happen with regulation.
Let's talk the outlook to go and finish off. When it comes to, you know, intergenerational wealth, the transfer that we're talking about at the moment between the generations, what's the biggest challenge going to be for yourselves there at WT to go and capitalise on that?
Yeah, look, I think the challenges for our advisors within our network to make sure that they've got an open mind to continuing education, and that and for all advisors to be part of a network that's got the right skills and experience to bring to the table on that, because you've got estate planning, you've got transition to retirement planning, the legacy planning, you've got more people moving into aged care than ever as a single cohort, so you've got aged care advice, and of course then you've got the investment advice for the recipients. So really important for people to keep their education going, and it's one of the things we pride ourselves on.
Keith Cullen from WT Financial Group, thanks for joining us here in the studio, and congratulations on that acquisition. The market has certainly welcomed the result today, looking at the share price reaction. Thanks for joining us on the program.
Thanks so much, really appreciate the opportunity.